Hello, hello. This is a special taping of the Opening Bid podcast where we will explore how investors should go about investing in that polarizing company that you know as GameStop and help break down the approach to trading in meme stocks more broadly. This is your ultimate 24-minute guide to building and not losing a hell of a lot of wealth in some of the most volatile, confusing stocks in the entire stock market. Here with me now is Freedom Capital Markets Chief Global Strategist Jay Woods and Interactive Brokers Chief Strategist Steve Sosnick. I'm sure it's been wild times for you both. Steve, I want to start with you. What has the activity been like for the GameStop ticker on Interactive Brokers amidst this latest meme stock insanity?
Hi, Brian. Thanks so much for having me. GameStop has been one of the most active stocks on our platform pretty much since the since the return of Roaring Kitty. It as of 5-day moving average that I look at, it was number 3 as of yesterday, and that was up from as of 5th place on Friday. So that throw in realizing that it's a 5-day moving average, it was probably the most active stock on our platform, if not just a close second to NVIDIA yesterday. But the interesting thing is it's been in the top 10 pretty consistently since that whole run up. And actually during much of last week, it was in the top 5. So our customers have remained active in the name. They tend to be very much drawn to highly volatile, high volume situations. And GameStop, for all its pluses and minuses, certainly fits that bill.
Jay, I love that you're coming to us from the iconic New York Stock Exchange. What's the chatter on days where GameStop has essentially takes over the market psychology? Well, what do you hear down on the floor?
Yeah, it's very different this time than the last time. This is more isolated to GameStop than it is a whole meme craze. A few weeks back when he first posted that meme leaning forward in the chair, that got a lot of stocks, especially stocks with short interest, to spike, and it was the AMCs of the world, but it wasn't anything like we saw a few years back. Now this time it's very different because the chatter is about the dollars involved. What we're looking at, one, the volume is down dramatically from the meme craze 4 years ago, 3 years ago, to what we've seen over this period, although it is one of the most active stocks on the floor. But there isn't this, unbridled, we're getting somebody. This is, I have a position and I want to take this to a certain level by a certain time because there are options involved. There isn't a movement behind it. And then Keith Gill behind the original movement. This is a lot of money invested in this stock. So there are a lot of conspiracy theories going on when we talk about this right now. How can he afford it? Why would he dare come back with this kind of size? And then it's just been memes. He hasn't come out and said anything. So we see a screenshot of that portfolio. We see the amount of the millions of dollars invested. This isn't somebody that did well the first time and is now coming back for more. There seems to be more to it than that. So there are a lot of conspiracy theories being thrown around. But the movement, it's not there like it was the first time.
I'll put this question to both of you. Steve, I'll start with you because, look, I mean, you guys look fabulously young, as do I. But the reality is you both have been doing this for a hot minute. I mean, you've seen a lot of different market cycles. And Steve, in your view, is someone with this influence over this particular stock, and we'll talk about meme stocks more broadly in a second, is this market a new form of market manipulation?
A new form? Absolutely not. I mean, it's actually in many ways analogous to, let's say, an activist investor, taking a position in a big name stock that they want some challenge to, that they see as undervalued, and by some, aspect, of just knowing that the market's going to follow them, and without picking on anybody. This is, that's kind of how Carl Icahn made his living. It's analogous. I wrote yesterday to Nelson Peltz, what he did in Disney. But there's one major difference. They're doing it in stocks that they actually really believe are undervalued. Now, Roaring Kitty, whomever he may be at this point, and I agree with Jay that it's not clear that it is actually Keith Gill. But it's it's pretty obvious that GameStop is not fundamentally undervalued. You could argue that some of the activist investors' targets are. Nelson Peltz lost the Disney battle, but ended up making a lot of money because it raised awareness in it. But in this case, I do think that there's just something so much more cynical about this, and it was what Jay alluded to. The original meme craze to me was very much us versus them. There was the us taking on those who dared to short our favorite nostalgic names. It was very much millennial driven. Think about the original names. It included things like Build-A-Bear.
I love Build-A-Bear, Steve. Who doesn't love Build-A-bear? You go in there, you get a nice stuffed bear. I mean, that place is great.
So how dare people short it?
You don't short
take
Build-A-Bear.
bets against the stocks that the millennials were dragged to, in the mall by their parents, or their parents consumed by their
By my
BlackBerries
ex-girlfriend.
while they were playing. There you go. And so what happens is it's not clear who them is right now. That's what makes it a bit. That alludes to Jay's point is, there was a clear us versus them, and if you're not sure who them is, well, them might be you. Because I do think they're using people as the sort of their source of liquidity, their source of profitability.
Well, Jay, hot potato to you. Is Keith Gill, or whoever this account might be, is this the new Nelson Peltz for this investing generation?
Well, first of all, that Build-A-Bear is a great analogy. I'll one-up you on that. Remember Tootsie Roll? You go back during that craze, there was a 2-day stretch where Tootsie Roll, the worst candy in the world, by the way,
that stuff sucks.
spiked. It doubled in a day, then came back down because...
Now, Steve likes Tootsie Rolls. I can see he's smiling. I think he's a Tootsie Roll guy.
I'm actually agreeing with you. I'm not a big Tootsie Roll fan. It's not the worst candy in the world.
Well, it's a stock symbol, TR, been on the New York Stock Exchange for over 100 years, and all of a sudden the stock that did nothing for years got memeified. So yes, that was part of the craze. And to your point with activist investors, I'll never forget where I was the day we hit the fourth circuit breaker during COVID, when hell was coming and Mr. Ackman was on CNBC, sorry, for competing network.
No, we're gonna block that out anyway, Steve. We're gonna block it out.
Okay, yeah, he was on and then put Yahoo Finance. He basically caused a panic. He yelled fire at a crowded movie theater, and the market went limit down. We had a 15-minute pause, as we did 4 times during that time. And what was he doing during that time? He was buying stock. He wasn't dumping his stock. They saw that he bought stock. So there are different ways to use your influence to get stocks to do things. We had Dan Dorfman in the 90s, and those were crazy times when he was talking about his stock. You have influencers whose job is to go on TV and talk about stocks, and they have a following, and you'll see people move them. In the case of Roaring Kitty, Keith Gill, listen, he's got a strong, loyal fan base that want to make money with him. Kudos to him for doing that. He's not registered, so I don't think he's doing anything against the law, but you have to ask yourself, this is manipulative, but is there any legal precedent that he is now, if he's doing this, breaking right now? And I don't know. It's a very gray area, and it's one that I think this will change the way we look at things going forward.
Well, I don't think I can ask Steve this. Go ahead, Steve. Go ahead, Steve.
If I may, I believe he was registered with Mass Mutual, and they had to pay a huge, like a $4 million fine for his stuff before.
Ooh.
So that's another reason. And there's another name that I've heard thrown out there, which I won't mention because I don't feel like having a libel suit. But it's a person who was an insider at the company, and that name was posited to me yesterday, and I'm like, if that person is doing it, they would be in violation of so many SEC regulations because of their insider status. So it's even more of a gray area than it appears because of I don't know if Gill is still registered, but he was once.
Well, Steve, I don't think I can ask you this one, so I'll put this one to Jay. For the good of the for the good of the market and for the good of investors and everything that investing brings, should he be kicked off of an E-Trade or whoever this is?
I don't think so. I always say let them continue to trade. I mean, the first time we came in to this, you know how many new retail investors we got to the market as a result of this? I think it was great. I was getting questions from teenage kids, college kids. All right, you're here, you're investing. That was great, and they stayed, I hope, and then they learned people are learning what a loss is in this investment right now, because if you bought the opening yesterday or you bought the opening 2 weeks ago, that was the peak. So there are a lot of hard lessons for the retail investor who did chase this right now. And that's what I like to do, is I like to, provide some financial literacy and use my experience saying, all right, you want to learn the stock market. What are your timeframes? What are we doing? Individually, should he be punished if it's this one person? Listen, if there's a law that he broke, then of course he should be punished. I am in a very highly regulated industry. We all are. I have, knock on wood, had a stellar, career over 32 years where, the biggest scratch on my record is you forgot to log out. I only went to get off the floor to, answer my daughter. Am I picking up at soccer? And I forgot to log out, and they're, giving me a warning. So I do look at this under a lot of scrutiny as someone that was an official at the exchange for years and no longer. We monitor these things closely, and I hope the SEC is doing their job. And if there's something that was foul about this, that they do investigate it. But right now, from an outsider looking in, and yes, I consider myself an outsider here, someone pumped something online that they strongly believed in, and they're profiting off of it. Now, is it that person? Did they do anything illegal? These are the questions that are going to be answered when they write the book about it 6 to 18 months from now.
All right, well, hang on there, gents. It's time for a quick break. Don't go anywhere, folks. We're still rocking our usual 24-minute conversation. So, Steve, let me get back to you. What do you think investors are learning from this latest bout of volatility in GameStop, and then secondarily the meme stocks more broadly?
I'd like to think they're learning important lessons about risk versus reward. People have asked me, "Oh, should I be telling people not to get involved in this situation?" And I really haven't. I mean, I recognize that people are always going to be drawn to volume. They're always going to be drawn to volatility. But the key here is where there's high levels of volatility, there's the potential for high return. There's also implies that there's a high risk of loss. You have to understand your discipline. You have to understand you have to go into it with your eyes open. It can turn out to be an expensive tuition payment if you learn the lesson the wrong way. So that's why I'm trying my best to get people to go in with their eyes open and understand the risk versus reward that accrues in a situation like that. And that's really, to me, the thing that people need to take away. The other thing, I guess, to take away is, do your own homework. Don't just chase somebody, because again, as Jay alluded to, if you chase those initial runs, you got clobbered on that first move. What was it, 3 weeks ago? By Friday, everybody who'd bought during Monday through Thursday was down for the week. Anybody who went into that Friday long was down. Now it's since rallied back, but again, anybody who bought, particularly in the pre-market yesterday, or on the opening print yesterday, at least today as we're taping this, is looking at a loss. So you do have to understand that these things are moving against you. And at some level, there's an old saying in poker, if you don't know who the sucker is at the table, it's probably you. And so you really have to be careful. What is besides who's giving you the advice? Maybe it's me, maybe it's Jay, maybe it's you, Brian, maybe it's somebody random. But what is their motivation for it? My motivation right now is I'm paid just to make sure that our customers stay customers and stay liquid. And so my feeling is I want to make sure that people are trading prudently, that there is an opportunity for profit, but that there's the potential for loss. But, I get sucked in, if I say even the most contrary, mildly contrary thing on social media, there's always someone popping up to flame. And I'm sure you're more than aware of that, Brian.
I am. Yes. Actually, I am, Steve. I can only imagine the comments we're going to get after we post this. But My motivation, Jay, I'll hand it over to you. My motivation has always been,
Yep.
and it's been for the 20 years I've been doing this. I was an analyst for 10 years. It is I always look through the prism of the fundamentals. So bear with me as I run through this. And I've written very critically on GameStop. About a year and a half ago, or maybe a year ago, I wrote an open letter to Ryan Cohen, who's now the CEO of GameStop, calling him out for his absolutely dreadful, horrific, horrendous job he has done, first as his executive chairman and now ultimately as CEO. So look at these prices. So Ryan Cohen, also the largest individual investor inside of GameStop, January 11th, 2021, he joins the board. Stock closes at $66. September 22nd, 2023, takes over as CEO. Stock closes that day at $15. Now, the stock actually on April 15th, shout out to my mom, that's your birthday, the stock closed at $10.42, some new lows there before all of this recent pickup in activity because of Roaring Kitty. Fundamentally, this business still sucks. It operates about 5,000 stores around the world. Sure, they have about 2,900 of their leases for those 5,000 stores coming up for renewal, but still, this is a legacy retailer doing absolutely dreadful. But I look at the market cap, gents. GameStop market cap, $9.4 billion. Macy's, they own real assets, real land, $5.1 billion market cap. Are you kidding me with this GameStop market cap? I look at Abercrombie & Fitch. I just talked to the CEO last week. Blew away earnings by 20-something cents. Their market cap is $8.59 billion. Lastly, Mattel, $6 billion market cap. What do? They own freaking Barbie, and they're blowing it up. I mean, Jay, the fundamentals do not support where the valuation is on this company. Now, I get it, it's being driven by sentiment, but this is absurd.
Well, stop making so much sense. And, you're talking to a CMT, a technician who studies price patterns. And what I saw 3.5 weeks ago was a breakout in this stock. And I was kind of like, how is this stock breaking out? And then the meme came a few days later. So price action was actually leading this move. Now, as far as targeting goes and how high this can go, as long as it's above the 200-day moving average, which is, under 20, then maybe something's turned around. But fundamentally, you are spot on. Listen, it doesn't make sense, and the market tends not to make sense. This is a craze. That's why we're talking about it, and it was one back then. I think the fundamental story in the beginning of this, when Keith Gill went on, his story took 6 months to pick up. He wrote this theory about why he liked GameStop and the short interest in it. I believe in the summertime. It wasn't until January it picked up. And as a trader, that thing took off, and it became the movement it was. And full disclosure, I was on garden leave between jobs, and I had time. I traded it. My couch is named GameStop. My TV's named AMC.
You traded GameStop, Jay Woods? You traded
It was
GameStop.
all momentum, but this is to Steve's point, and this is the most important point. I traded with stops in place all times. Mm-hmm. And I remember, and I'll go to AMC because I bought it at 4, and I sold half my position at 6. And my teenager's yelling at me like, what are you doing? It's going to the moon. He was totally in on the craze. And I sold a little more at 8. This is risk management. I look at him. I've been doing this for a long time. These moves don't normally happen. When you can get a profit of 50%, 100% within a day or two, you take it and you say thank you. And then I traded all the way up to 20, and I sold my last tranche, which was like 100 shares of an original 3,000 share position.
Jay, for the new investors listening, real quick, how do you define a stop loss, and then how do you define it on a stock like GameStop?
Exactly. So it's about risk management. When I go into a trade, I think, what's the worst I can lose? Obviously, you buy a stock, you want to go to the moon. That's, if you're thinking like that, then you got to check yourself at the door. But you want to have a gain, a reasonable gain in the stock. And if you start to have that gain, what you want to do is protect yourself on the downside. So what you have is a stop loss. So if the stock goes from GameStop, it's trading at 27 as we tape this. If it goes up to 30, you know what? I bought it at 27 just now. If it gets back to 29, maybe the momentum will continue lower. I will stop myself out once it ticks at that price, and I'll have a sell order in the market, but I'm protecting those gains. And so you want to have a trailing stop on the way up, meaning as it goes higher, I am going to put my limits a little higher. And if it ticks down, I'm out. That's just safety the way of doing it. As a professional market maker for years, stops were got me into stocks as well. I use buy stops on breakouts. So the stop is just a safety measure because you could turn your back for 1 second, and how volatile and active this has been, you may miss a huge move. So you really have to be on top of these trades, and stops are the best way to protect your capital or preserve the loss. Because when you get into a trade, 4 things can happen. It's very simple. Small loss, small gain. These things happen every single day. The goal is a big gain. We all want that. Doesn't happen easy, but if you get it, you want to take it. In my career, I've seen too many people blow up because they didn't avoid the one thing, that big loss. And the stop order avoids the big loss. You know, if the stock goes down 20%, I'm out. 10%, I'm out. What is my pain threshold? But I'm not going to give up my whole nest egg or my savings or what I put into this trade because I didn't protect myself from any downside risk. So to Steve's point, the whole thing is about risk management. So if you are trading this, you're following a crowd, you better have a game plan if it doesn't go against you, because it's a game of musical chairs. When that music stops, you have no place to sit. You're going to lose a lot of money, and that's not what we want to see as investors in the market.
Steve, is my way of crunching numbers on GameStop outdated? Do I just need to stop looking at their leases, their cash flow, their losses, and just finally come to the realization this is never going to be a normal company again until it goes out of business?
No, it's not outdated, but it's not what the market is focused on at this point. You can never lose sight of the fundamentals. Okay, GameStop, I ran some of them myself yesterday. GameStop made 5 cents last year, which was the first time it made a profit since 2019. In the prior 3 years, GameStop's net cash flow was a negative 930 million or so, which, to be fair to them, they sold about $930 million worth of stock into the rally recently. So that shored up its balance sheet. So you can argue that this whole movement did leave the company in a better place because it was able to refill its cash coffers. Presumably it's retiring some debt. So that's good. So that might be able to help its profitability. It's still not expected to make more than about 10 cents next year. So, do the valuation off of that. There's all the other stuff. So you can't. So that goes back to what Jay was saying in terms of the risk management and what we've been harping on. You have to have a sense of what this company might be worth. If you think the company's worth $17 a share and you buy it for 22, all right, that's okay. And maybe I can get stopped out and I'll be all right. If you buy the stock for $27 and you think it's worth $2, well, you really better have some tight stops on there because you're sort of dancing on the volcano to a certain extent. So you do have to have sight of what the fundamentals are. Going back to what I said with the activist investors, believe me, Carl Icahn, Nelson Peltz, all those guys know they have a number in their head for what this company is worth whenever they're doing it. And, they're taking on risks, that can be phenomenal. They can't really stop them out, but their stop out there is the fact that they have an understanding that the company is worth what it's worth. In this case, it's really hard to say that it's worth anything significant. And so you have to keep that in the back of your mind, and that better reinforce your discipline in terms of how you do it, whether it stops. I'm an option guy. I use options a lot of times, but this is how you have to approach it.
So 30 seconds left. I'm giving you each 15 seconds. Jay, over to you. Your final message to anyone that owns one share of GameStop right now. Go. You're on the clock.
Yeah, hey, good luck. I think it's great to be involved in the market, involved in a craze, but be careful. Use your stops. This thing is going to move, and it's going to move quickly, so you have to be on top of the trade.
Steve, over to you.
Literally what I was going to say. Stay on top of it, but keep your risks very controlled. Don't get ahead of yourself. Bulls make money, bears make money, pigs get slaughtered.
True friends of Opening Bid coming through for us with this special edition, the ultimate guide to investing in GameStop and meme stocks. That's it for the latest Opening Bid. We'll catch you soon.